Hello, everyone. Welcome to today's session. Happy Tuesday. Let's get underway. Hope you're all having a nice week. Market conditions. Let's start out with a long-term perspective and kind of set the table there. This is referred to as a top-down approach. Top-down approach is when we're looking at what's the overall long-term trend of the market. What's the big picture? And from there, how do we drill down? How do we zoom in on that big picture into the smaller picture, into the fractal of the days and the weeks and the months, and what does that mean for allocation and individual stocks? And so we'll spend some time on that. But the big picture is we definitely know that we are in a long-term uptrend. This line right here, so this upper chart on the directional alerts tab, directional alerts, market trend tab, and this slider bar is a representation of this line right here. Now, it only goes to 5, okay? And that's because historically, when I built a lot of this out, that was a maximum range. And so I've got to adjust that. So this line actually is showing the actual number of 19. And so this is at the extreme right here because it's 19. It should be clear out here. So when you see that stuck kind of right there, just look at this number and know that, the slider bar right now is clear off the chart right now. And that can stay that way. You can see some of these upper ranges, 22 in the last 5 years, it's just been really, really volatile, really wide swings to the upside and the downside. And as I mentioned, a couple of years ago, it got up to that 21, 22 range when we hit this top right here. I even think the COVID top, it was in that upper range right there. So we're as extended on this indicator as we have ever been. We're getting very, very close to that. And you can see that just by eyeballing kind of the magnitude of the rally right here, even this line right here. So now this lower chart right here is the S&P 500 over the last 20 years. So there's two different parts. So this part right here is only analyzing the last year. It's only showing about this much of data. This green arrow that's right here, when we get this arrow, this crossover, it's right here at this point. So when this red line starts to go over, once it crosses over into that uptrend, that's what's happening right here. So when you're looking at this chart, you're really just looking at a zoomed in perspective of this time frame of this last year. And so obviously we've had a massive rally. We're towards the upper end of that trend. This point right here, this high, and then this retracement was this high, and then this retracement right here. So in terms of, when you're looking at a chart and we start looking at a chart that does this and it retraces and it gets here and it's towards the upper end of that trend, we know two things. Number one, we know that it could still go higher within that overall trend. We know that at some point it's going to retrace. It has to. It's going to give us one of these. Markets just don't go up forever. And the pendulum swings at those edges. If you've ever been to like a planetarium or somewhere that has one of those really big floor to ceiling pendulums that, that just swing back and forth, they have maybe a ball on it and they just kind of go back and forth like this. And you think about that pendulum, and as it's swinging and it tops out and it starts to, the momentum swings to the one side, okay? And then that momentum stops, and then it starts to swing back the other direction. Okay, the market kind of acts like that when we're swinging this direction and we're moving back and forth. And so we get this, we get about right here, and then we get this momentum that just pushes us. Well, at some point that momentum has to stop. And the momentum is run by supply and demand. So you're getting supply and demand, and the supply demand is simply the buyers and the sellers in the marketplace, the buyers and sellers of stock as a group, the entire market. And at some point that psychology of the market starts to switch, and you get both sides of that pendulum. You get greed on the one side. Okay, when we're starting to move higher, you get greed because it feels good. This is nice. This has been a nice market. It's a nice uptrend. Every pullback we buy into goes up. Okay, and we get these time frames, and they can last 6, 8, 12 months. But we also get these time frames where things are moving lower, and everything we buy reverses or stops out, or every other one, or it's just a really, really frustrating time. It's because we're fighting the downtrend versus either waiting it out or reducing the risk, or whatever the scenario is. Market conditions just behave different in this environment than they do in this environment. Individual stock picking, it doesn't matter what the scenario is, it just is different. So every year, every market condition, every environment, every week, really every month, it's just different. It's never the same. And so that's one of the nice things about the stock market, but it's also one of the frustrating things about the stock market is it's always changing, and whatever has happened up to a certain point may or may not ever happen again, or it may or may not happen in the same way. It typically rhymes. You've heard that phrase. I don't know the exact phrase, but it's, history never repeats itself, but it rhymes. It's the same way in the stock market. It's never exactly the same story, exactly the same trend, exactly the same stocks or market that is, or technology or thesis or bias or whatever's happening in the market. It's never the same thing each time. You have the dot-com move. If you were to go back even to the 20s and 30s and 40s and 50s and 60s and think about the evolution of technology and the evolution of stocks and companies that have advanced, they're different about every 20 years or so, and major players start to take over. So we've had this massive run up of, starting in 98, 99, where we had this really big uptrend. In fact, even this chart right here, we go back to 2010. Okay, starting in 2010, really has been, it really has been a relatively uneventful market, minus COVID. Within this overall uptrend, we haven't had a real big collapse, and even this was just kind of a retracement counter trend. And so and then you have subprime. So you have this run up in .com, you have this run up in commodities and in mortgage-backed securities. The invention of financial, derivative products was the 2008 issue. We get to 2009 and 10, we now have, and 15, we started to have cryptocurrency that was coming in, kind of this new technology that started creating additional companies that were being added in. You get, and then you get kind of the retracement of that, the pause. This was all of that Fed money that was pumped into the economy during COVID. That money's got to go somewhere. It went into stocks, it went into crypto, and it went into meme stocks. It went into, we had this really big speculative run. Anytime we get those, it's going to retrace, it's going to consolidate, it's going to correct itself. It doesn't necessarily always mean that it's going to collapse, it's going to reverse. So I try to just keep things balanced. And, I've been doing this a long time, and I like reading and understanding both the really, really fearful scenario and the really, really conservative scenario, because the truth lies somewhere in the middle typically. And so if you're extremely bearish, thinking, the end is near, it's going to collapse by 50%, or whatever the giant YouTube meme is with the guys with the red eyes right now, or or the fire in the background. It's just, it's marketing as well. Everybody's got they all want attention, and trying to get the attention is the hard part these days and so even then, it's just what can I say? What are we talking about? What are we doing? What are we fearful about? What is exciting? What's the new opportunities? Those are always changing. And so now we're dealing with AI. We're working through this new technology and this new uptrend. And that really has been this entire rally from here to here are mostly that, technology and new ideas and AI and biotech and really even these biotech stocks that are moving higher because of AI. They're anticipating that biotech is going to really benefit. So no, it doesn't last forever within this current trend. Okay. My personal opinion is that the stock market is designed and will always go higher. It will always go higher as long as stocks and companies and growth and earnings and the entire metric type, not the metric system, but the metrics that we are measuring growth and we're measuring value and we're measuring the ability to consume different ideas, those are always changing. You know, you get Facebook, Google, Meta now, and you get some of these other companies that are like Nvidia. They're just different. You know, just like IBM and Microsoft. Those were ideas that came. They become mature companies. They can't grow as fast as they normally can. They become these big behemoths, and they go buy up all these smaller different companies or ideas. It's just an evolving theme on the overall same idea, and that is expansion, that is growth, that is development, that is progression, and that's what ultimately for me what the stock market represents is these ideas and this evolution of uh, of human expansion and ideas, and that, you know, those ideas come and go, and the greed and the fear cycle comes and goes. So right now we're definitely in that greed cycle where you get fear of missing out, because it's like, well, man, this thing just keeps going higher. At what point should I sell? At what point should I be buying more? Okay, so there's no real answer to those questions, because everyone's goals are slightly different in terms of what you want out of this growth. Okay, we want to participate, and we want our assets to be able to grow with that growth of these companies, of these ideas. And we can typically do that by buying the stock or buying shares of the stock of these companies. Now, to be able to evaluate the market environment, it takes, you know, there's lots of different ways to do it. You get all of the economic perspectives, you get all of the Fed stuff, you get all of the earnings reports, you get price pattern and technical analysis, you get valuations, there's lots of different ways to try and determine what direction do I anticipate this idea, this asset, this stock to go higher or to go lower. And then we got to pull the trigger. Then we got to place a bet, and we've got to anticipate what that outcome might be. If we're right, anticipate if we're wrong. And that's simply setting up stop losses, adjusting a portfolio. And my primary approach is the portfolio approach, and that is buying stocks as a part of a portfolio so that you're diversified, you're in different things at different times, you're not betting all on one idea or one stock or even a group of stocks. It's trying to take advantage of what is happening in the current market environment, what trends are developing, what ideas are starting to work, which ideas are starting to fail. And that becomes this rotation process of portfolio building. It's not for the faint of heart. It's not for the light stomach out there, because you get volatility, and you get ups and downs, and you get stop outs, and you get big winners, and you might have a big loser. You might have a whole bunch of little small base hits that are boring. You might get, you're going to get every single one of those scenarios if you're doing this long enough. And one of the things that you will learn, and for those of you that have been doing this long enough, you can't always predict the direction. You're going to get things that move up, that move down. You're going to get things that don't act the way that they normally do, and that's kind of what I'm starting to see right now in a few of these stocks and a few of these sector areas. Is you're just starting to get reversal and profit taking, and that starts to reverse some of the trends on these things. So one of the ways to be able to do that. So let's finish up this perspective, and that is we're looking at not a whole lot has changed right here. This chart is S&P 500 for the last year. This is that uptrend retracement moving higher. This information here is talking about sentiment. We know that sentiment is still really good. It's really positive. Breadth has been improving. That is this green line right here. Momentum has been kind of stagnating, kind of flat right here, but still moving in the right direction, still bullish, still positive. And so we still have that overall bullish bias because we haven't had a real hard trend reversal to the downside. Every time we pull back into this buy zone, it just keeps getting bought into. So all of these pullbacks we're getting here, all of these have still been working within this overall uptrend. We've yet to get a big enough downturn to even break through any support or breaking anything that's breaking this overall trend. When that starts to happen, we want to continue to trust that trend direction, but we also want to be aware of this. We also want to be aware that we're at the upper end of the trend. already. And so yes, we may be pulling back into a buy zone, but we're at the upper end of this long-term trend. That doesn't mean sell everything, but what that means is I've got to be aware of where that trend is at, and that there's a probability that all stocks could reverse. And that tip is, when the market starts to reverse, you get everything that starts to reverse, and that's that's just a part of the game as well. So here we've also got buy-sell ratio, which is slightly positive, not extreme. Again, just this slightly bullish bias to the overall market right now currently in an extreme condition. In the overall new buy portfolio, we having some volatility here and seeing and stopped out of 4 or 5 different trades, added into a few different new ones, and seeing some things that are starting to act well, and some things that are starting to not act so well, starting to reverse. And so that starts to happen as we're rotating out of one trend and rotating into another trend. That can be those are called sector rotations, and or just a rebalancing. Those can create drawdown. And drawdown is simply when you go from a high water mark, this was at about 38%, back down to about 35%. So we're down about 3% in the last 2 or 3 days, with some volatility and some stop outs. That volatility, that is a natural process. That is this up and down. So it always is great. This always feels good. Okay, we're going here. Now we get a retracement, we get stopped out, and we're like, God, what the hell's going on here? I'm just, should I be selling now? And so our emotions get sucked in to this process as well. And if we don't have a strategy in place, we end up making bad decisions, both in this direction and this direction. So we want to be able to understand what this means for us individually, okay, what that means for you individually. And that is essentially how much risk, how much volatility am I willing to accept with my capital that I am allocated. Okay, and that is essentially you may have heard the 60-40 allocation, 60% stocks, 40% something else, typically bonds or cash. Okay, that's an allocation adjustment so that you're not getting everything in stocks and getting the volatility, because we want to be able to have, say, all of these stocks start to reverse all at once. Well, the entire portfolio is not all in stocks, so we're not going to get the same reaction as we do in the entire stock market when things start to move. So this allocation, you'll notice that it went a little bit higher. It went a little bit higher. We had, as of 3 or 4 days ago, this was our cash level. Now, this is our cash level. We've got a larger position in cash, now 67. Okay, so about, roughly, I don't know, 60% in cash and the rest in equities still. Now this percentage of equities, we're still adding into these. We're still going to continue to add into those. So in this case, the most recent couple of trades, we've got HMY, Harmony Gold. So we're seeing a rotation into gold stocks. We had another trade that came out today, which was another gold stock here. Some volatility, obviously, but those are starting to shift and starting to move higher. And we're seeing some of these other names that have had this uptrend already, stocks like that have maybe got to this point, and then they're starting to break down. They're starting to fail this overall uptrend. And once that happens, we just simply need to exit and remove those stocks out of our portfolio by selling them, by adjusting or honoring their stop loss and taking that stop loss and making sure that we're out of those rotations. You can have a scenario where you get 3 or 4 or 5 stop outs all on the same day. And my perspective is that's actually quite a healthy thing. It's the natural evolution of the market getting rid of, for us, what's not working. Okay, so if we had, let me see if I can find an example. Let's look at, CLSK. This thing, these crypto miners have become just real dogs, and I'm really hating them right now because they're just not working. And so in this case, you had a buy signal here, big gap up, immediate reversal, immediate stop out. Okay, that happens, and that's a part of the discovery process as well. We never quite know, which stock is going to be the one or the sector that starts to improve and starts to take off and starts to work. These miners, obviously, in relation to Bitcoin, are really battling. I still need to do some research and understand why that is. I don't quite understand that why that is happening when Bitcoin is now getting to 70,000 plus. It's had a massive run up from the 20,000 range up to this 70, 80,000 range. It's really on fire right now. So this part happens. This part happens of buying something that you anticipate to go higher, and it doesn't. Okay, so we have to be able to prepare for that possibility, and that's what a stop loss is for. Okay, in this case, we set a stop loss right below that bar, stopped out. Yes, it might turn and rally and move higher, and that is a frustrating process. That happens, getting stopped out, having it reverse and move higher, but that doesn't matter because this is a play that's over now. And now it's a new play. Now we've got to consider if this does strengthen, maybe we will get into it, maybe we won't. But at this case, I just needed to honor that trading plan, honor the stop loss, meaning I've got to follow my rules. I've got to follow my plan. And in the heat of the battle is the hardest time to follow your plan because we want to second guess ourselves. And we want to say, oh my gosh, what if it bounces right here? Okay, what if it finds support and moves higher? Okay, there's 1,000 woulda, coulda, shoulda scenarios every single day that don't matter. They're just irrelevant. They may or may not happen. We have to be able to plan for that of them happening or not happening, and that is essentially the methodology we're using. And that is, if it goes higher, we continue to let that go higher. If it doesn't go higher, we stop out of it and we replace it with something else that has a better pattern or has an opportunity to move higher based on the new pattern. It may not work either, okay? But then we move to the next one. It may not work either. We move to the next one. Then that one works. Then the next one works. Then the next one doesn't work. Then the next three work. Okay, then so you're just, every single time we get into a trade and every single time you get into a trade, your expectation should be very, very low. The expectation is I'm protecting my risk based on my stop loss. I have no idea if it's going to go up or down. Okay, but it's in a new sector, it's in a new uptrend, it's something I don't own, it's something that is working. I want to be able to continue to take stabs at those potentials because over time they're going to work. Over time we're going to get a handful of stocks that do catch those overall uptrends. So as we're looking for opportunities, now here's another example. When you start to see leading stocks start to do this, and this happens all the time, but when you start to see consistently stocks that are uptrends, immediately reversal, stop out. I've seen it on a lot of stocks recently, and that is a rotation. That's a rotation out of one trend. It could just be a deeper retracement. Just like that crypto stock, just like we CLSK here, CLS back here. This retracement, it gets stopped out, it kind of flounders here, and then ultimately it trends down. Now, you can, depending on your strategy, you could say, I'm just going to wait it out. I've got no stop loss, but I've got a really small position size. Those are the two things we control. My position size, if I don't want to have a stop loss, but I like the idea and I'm like, hey, I'm just going to buy it, and I think that it's ultimately going to go higher over time, then, and I'm not going to use a stop loss. In that case, I've got to control my risk with position size. I wouldn't have a very big position if I didn't have a stop loss. And it's okay not to have a stop loss as long as you're controlling your risk with your position size. Just have a smaller position, meaning less shares. Okay. So these are all things, these are all questions I can't answer for you because it still comes down to volatility. It still comes down to when you have a day like the last 2 or 3 days and you see your portfolio move down by XYZ amount, how does that make you feel? Are you freaking out? Are you stressed out? Are you worried? Are you okay? If that is the feeling that you've got and you're worried about the volatility and the ups and the downs, your positions are too big. Okay? You've got too many holdings or you've got too big of holdings. If it's just another day and it's just another move and it's just another stop out and you're adding into another trade, okay, and you're feeling fine about it and you're good with the size of the position, that's kind of that gut check, you know, and that's really not the official technical term, but you all, I would imagine, know what I mean when you're dealing with volatility and you're like, oh my gosh, that is just too much volatility. I can't stand it. I can't take it. Or in the past, maybe you've had a situation where you're like, I didn't realize that a stock could drop like that, or I didn't realize that that it could happen in 10 minutes or happen overnight. So it's just about adjusting what that risk amount is and how much of the overall pie I'm willing to put into these momentum trades, into these ideas that are going higher. So these cycles right here where we start to see things starting to shift, you're starting to get some profit taking, that's a part of what's happening right here in the market. And we start to see a little bit of cracks in the trends. We start to see, you know, buy-sell ratio. Right now, they're kind of pointing back together again. We'll see what the market does today. It's still bullish, but you can sense there's not a whole lot of buying or selling right here. It's just kind of a wait and see market, and that's okay. So let's look at, again, now that was really part of what I wanted to talk about here, because markets are they're just at the, you know, they're at these extreme ranges right here, and nobody knows what they're going to do. Nobody knows if they're going to continue retrace and continue higher, if it's going to retrace and go lower, if it's going to just flatline here for the next, you know, year, if it's going to go up, it's going to come down, it's going to move sideways, it's going to, like, nobody knows that. So we have to go into this scenario of uncertainty with a strategy to manage that uncertainty. And the uncertainty is, I don't know if it's going up or down. If it goes up, that's my expectation. But if it doesn't, I don't want to overly create a fake or a false hope or a false expectation of positivity or upside, and then get burned because I took too big of a position, just like CLSK yesterday. Okay, if we would have taken too big of a position, we took a position size that was comfortable for the amount of risk that we're dealing with. And this is always a possibility, and it happened. And so what? It stops us out when we move on to the next one. It's frustrating, yes, but it's not a big deal. It's just that it's like, you know, it's just a part of doing the business of trading, and getting stopped out is a natural part of it. If you don't like that, if you don't like the stop out scenarios and you don't like adding into so many trades, then you've got to use a smaller position size and allow for some of the volatility. And I suggest you use a smaller than normal position size anyway, as you're learning about your own risk tolerance, as you're learning about your own ability to handle volatility. Use small position size. There's no reason, you know, the inability or the lack of knowledge is, it can only be achieved, you can only gain knowledge by experience, and the only way to gain the experience is to do it. And so the only way to do it without taking ridiculous risk is to either use a simulator, okay, use a portfolio builder, use those are not real money, and or you use really, really small position sizes with your real money. I want to buy this stock, I want to do this portfolio process, I want to buy something live and real, buy 1 share, buy 2 shares, buy you know, a small amount, so that when you're dealing with, you know, these changes 10, 11, 12%, you're talking about, you know, 10, 12, 15, 30, 40 bucks, okay, 50 bucks of volatility, not $400, $500, $600 or $1,000 or really big. That is to help in the learning curve. If you're past that and you're comfortable and you know exactly what I'm talking about, then fine, ignore that. But I still think even then there are times where you get too comfortable, where you might start to take on more risk than you actually realize that taking on more risk than you think you have, and that's and that happens with your allocation, your percentages. So in terms of your position sizes, with this method, I usually teach 2 to 2.5%, okay, 2.5% of the overall account. So of a $100,000 account, a 2% allocation is a $2,000 trade. And if I have, you know, say a 10% stop loss on that, and 10% of 2,000 is 200, that's my risk. So I'm investing, my position size is 200, my total risk is 200, which is that's going to be 2 of 1%. Okay, it's a fifth of 1% that I'm going to lose if this amount stops us out. Is that okay? Is that a good number you can deal with? We don't, I mean, we don't want to have them consistently. We don't want to have them ever if possible, but that's just not realistic. It happens. We're going to have those. So understanding this scenario is critical to consistency and to mental health. The mental health of your portfolio is valuable because you need to be able to make non-emotional decisions, and money is always emotional. I don't care who you are, money is always emotional, and it is. We want to be able to make sure that we're using a system to mitigate the risk, and that's essentially, it's a very easy way to manage. It's a very easy process as well. Sometimes it's a little bit harder to stick to. Maybe you go 2 or 3 stop outs and you become a little gun shy to take on a new trade that day. Okay, it's like, well, I got to stick to this methodology. You know, maybe 1 or 2 or 3 of these new stocks I'm adding in the last few days become some of those new big winners that we've got. We haven't got any now. We got stopped out of our biggest winner yesterday as well. So now we had that, you know, now we're back up to 40, 50, 60%. Some of these other ones are newer. We're getting some rotation, and we're seeing, you know, HMY and AMD and some of these other stocks that are just becoming new fledgling trends as those are starting to develop. So it's a fun process. It can be stressful if you let it, if your risk is too high, if your uncertainty is too high, if your knowledge and skill set is too low, then it can become a stressful scenario because of, I don't know what I'm doing. I really don't know what I'm doing. And therefore that's making me scared. And that is creating losses, and that is creating pain at the dinner table and the conversations, or whatever. It's just our goal is to increase our capital, to grow and protect our capital, to grow and protect this wealth and money, and do it in a way that utilizes stocks and the stock market to do that, to grow that, and buying individual stocks at that time. That's that wheel strategy that we're utilizing, and utilizing momentum stocks as they're trending and moving higher, and then making sure that our position size is within our risk tolerance. I'm just going to summarize here. So again, market conditions, we're still bullish. We still want to have that bullish stance. We still have a positive buy-sell ratio, but we also have S&P 500 and really all of the markets that are towards the upper end of this range. This last few weeks, even though it's kind of been quiet and just headed higher here slowly, that's good. It's better than a real big uptrend or fast one and then a quick move down. And S&P 500 has just kind of been chugging along at a decent trend. A sustainable trend is at about that 45-degree angle on a chart. So on S&P 500, you know, we're about 45 degrees, not quite, but if we were to start to look like this, which a lot of stocks are going to look like that, then we know that those don't last either. We typically get a retracement, pulls back to around that 236 number. It either continues lower, or it finds the support and continues that trend, or it doesn't and we get stopped out. And maybe this one, you know, maybe it revisits that uptrend at some point in the future as well. And if it does and it comes back into that new uptrend, then we might consider it and retrade it again. But there's always opportunities of stocks that are making new buys to be able to jump into in the really every day in current market conditions. So I'm going to end on that note. I appreciate everyone's time and effort, and enjoy your week this week. Thanks a lot. Bye now.